back to Uno Minda then, and talking about the earnings. First of all, hi Sunil, great to have you on the show. Thank you so much for your time. Talk to us about the themes that have been working really well for the company, because we understand that yet again it was a bit of a premiumization, import substitution, EV disruption, which has been working well for you. In 2025, how do you expect these themes to accelerate your growth, and what kind of impact we can see in your volumes and profitability?
Absolutely. All these areas which you have touched, be it the lighting, be it the EV, be it the sensors, alloy wheels, there are a lot of businesses which we are in. They continue to ride the premiumization theme, and our view is that it will continue to be then medium to long term as well, because the penetration which we have currently today is way, way lower in some of the spaces like alloy wheel, LED lighting, etc., compared to the global markets. So the growth in terms of what we have delivered, if you see 9 months, almost like 20%, and the current run rate we have is almost 20% year on year. So we do expect this current momentum which we have built to continue. In fact, as we move forward, there are some new products as well, and new capacities as well, which will come on stream, which will support the growth momentum in the medium to long term. As you know, we have already 13 projects currently under execution. Of that, 2 were commissioned, and we have added one more. So almost like 2,800 crore worth of projects which are under execution, and they will come on stream in next 12 to 24 months. So there are a lot of action going on in terms of existing businesses, as well as the new business, which is the EV space, and also the sunroof, etc., which will come in maybe around 18 to 24 months online.
Has the slowdown impacted you any which way, both locally and globally?
No, absolutely, yes. We are part of the entire ecosystem, and we can't remain untouched. So there are spaces in Europe and US where we had some headwinds in terms of volumes. So our exports to this region has been impacted, and even the operations which we have in Spain and Germany, we have seen a significant drop in volumes there. But for us, fortunately, it is a very small portion of our total revenues. So our total exports and global revenues put together is roughly around 10-11%. So there, half of it roughly is ASEAN and half is US and Europe. ASEAN is doing pretty well. So it's only half of roughly that which is having some headwinds. Otherwise, if you see 94-95% of the portfolio, we are seeing a significant growth. In fact, in ASEAN, last year we have commissioned a new plant in Vietnam. And as we speak, we are constructing a new plant in Indonesia. So we are seeing good growth there. And India, we know we are doing exceptionally well, coupled with our strategy to improve kit value and add more products.
Let's understand what happens now. I mean, there could be a trade war, there could be a tariff interplay. The area which you represent, it's a very price sensitive area. You know, OEMs, they always fight for, like we say, chavani athani, right? If I may use that Hindi terminology. So what happens because of this tariff war, when currencies are fluctuating here and there? How do you plan? How does one know that next 6 months would be volatile or they would be predictable?
No, definitely, as I said, we are part of the global supply chain, and these measures do impact. But fortunately for us, as we speak, 90% of our revenues is a domestic revenue. So from that perspective, we are insulated. Whatever tariff war happens globally, because we don't have much of exports as of now to those regions, not much of impact. Yes, it might impact other players who might be in that fire range in terms of the impact. So like example, we have a small plant in Mexico, but majority of our supplies is within Mexico. Like in Spain and Europe plants, we primarily supply to that region. So to that extent, it does not have impact of any trade war between 2, 3 countries. So from that perspective, we are fairly insulated, I would say.
Give us some sense on your margins as well, because what we understand that the new capacities are coming on board. Help us understand that how is you getting the benefit of operating leverage, and what is keeping your margins back to grow in terms of the numbers, because what we understand is that it is because of an adverse product mix that you are seeing right now. Give us some more sense there, that what is the way forward?
I won't call a significantly adverse product mix. Yes, there are some new products which do not deliver those margins, and we all know. So when we put a new plant or a new capacity, our target is that in the third year of production, we should achieve our targeted returns and the revenue, etc. So initial 2 3 years, they normally pull down your overall average margins because they are in the ramp up phase. You have all the fixed costs running in, so the existing business has to absorb. So, and that is the whole reason. If you see for 9 months, our revenue is up by 20%, whereas EBITDA margin is up by roughly 14 15 basis points. So we are at around 10 11% versus 10.85 10.86 last 9 months. So the full benefit, as you called operating leverage, right, is not maybe flowing down fully because of these new plants which are under startup phase. And we have a lot of these plants, as I said, which are coming on stream in next 12 to 24 months. So in medium term, we are trying to sort of see how we can make operations more efficient and still maintain our margin and absorb those startup costs within our existing businesses.
Right. I wanted to understand, Sunil, very good morning. This is Cheryl also joining in the conversation. Wanted to understand your debt actually is constantly going up in order for growth capex. If you could help us understand how do you plan to bring this lower, and or do you think that it will remain at these levels given the fact that you are actually going ahead and expanding?
See, the large part of our capex is probably internally funded because if you see our debt, net debt has increased almost like 600 crores in last 9 months. Of that 600 crores, we have built a land bank of almost 400 odd crores plus obviously dividend payment, etc. So if you see, if you carve out these investments like land or dividend, etc., all the capex, be it the sustaining capex or the growth capex, or maybe the working capital which you need. So your top line grows by 20%. Obviously, you can't expect to run the business at the same working capital level. Your working capital also increases maybe in terms of inventory or debtors, etc. Right? So all that growth also has been absorbed by existing business. So it is, if you see, large part of that growth in debt is primarily because of these one-time areas like land, etc., which we do not expect to come in the future years. We have bought significant land, and there are a couple of areas more left. So hopefully in next 3 months or within this fiscal year, we should be done with this investment in land. As we move forward, our debt equity stands very healthy at 0.35. And in terms of our balance sheet, it's pretty robust. In terms of cash flows, fortunately, we have got very good internal accrual or internal cash generation. So hopefully we should be able to meet the large part of our growth capex through our internal accruals.
The best for that, Sunil. Thank you so much for joining us on ET Now to talk about the quarter gone by for Uno Minda and the way forward. But on that